Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Global markets are turbulent right now as concerns grow over the latest wave of COVID infections. There have been sharp drops in markets at various times over the last couple of weeks, from the ASX to Wall Street and the European indexes, and then they've jumped again. I wanted to look a bit more closely at trading on these global markets, how the uncertainty has hit them, and how to get through it if you're an investor. Cindy Leung is the Senior Wholesale Relationship Manager at trading platform CMC Markets. Cindy, welcome to Fear and Greed.
Thanks, Sean. Good to be here.
A lot going on at the moment. I mean, by the end of last week, we had indices pretty much close to record levels. Maybe not the London's FTSE, but the others were pretty good. Why are we seeing all this volatility on global markets at the moment?
Yeah, as you mentioned in your intro, the main issue that's on the forefront of everyone's mind is certainly the global pandemic. Just last week, we saw the Dow Jones Industrial Average close down 725 points, or close to 2.5%, after dropping as much as 946. It ended the week pretty much at its high. And so you can actually see that there is a lot of uncertainty surrounding the global recovery. The sell-off comes as the virus continues to spread across Europe and the world, and it's just sending jitters across the market. On the other hand, we've also got inflation, which is causing market volatility, and in particular, the rate at which it's rising. And this is seen across the globe, so it's not just Australia, the US, Europe, and the UK. The CPI, as an example, the CPI in the US jumped 0.9% in June, which is the most since 2008. It well exceeded analyst forecast of 0.5. This nearly doubled what was expected. As such, some investors saw the data as putting more pressure on the Fed. The S&P 500 declined following the release of the CPI figures. Even though it was temporary, the Fed and Biden did reinstate that high inflation figures quoted is simply transitory. As such, an increase of interest rates is not likely. So it's statements like this that is actually also causing volatility in the market.
Okay, Cindy, so what about earnings season? Wall Street's in the middle of earnings season at the moment. We've had some pretty good numbers out of the big financials particularly, and some of the tech stocks too. What's your take on earnings season in Wall Street so far?
Yeah, the earnings seasons, I think the market is expecting quite strong earnings. In fact, companies reporting, you'd have to beat analyst expectations to see the stock price continue. I mean, the surprises for me were certainly Nike. That kicked off the US reporting season with a bang. They exceeded earnings expectations by a whopping 89%. So clearly consumers are taking their exercise very seriously in lockdown.
Seriously, yeah.
Nike reported an EPS of 93 cents versus the market expectations of 51. So, as I said, that's probably nearly doubled expectation. This saw the share price increase by 12% on the day.
It's funny, in Australia, we expect companies to hit expectations, perhaps beat them slightly. But in the US or on Wall Street, it certainly is about beating market expectations.
Yeah, that's right. It's possibly because valuations are pretty stretched at the moment. The stocks may appear expensive. So given that, the market is expecting companies to beat earnings and not just meet them. If you meet expectations, you pretty much fall short and you'll be punished.
So tell me, what are you expecting from Wall Street in the next for the rest of this year? As you mentioned a moment ago, it is at its highs and valuations are stretched. Do you think it can continue running?
I certainly think it will continue this trend, especially right till the end of this year. This week will be interesting with Tesla, Alphabet or Google, Apple, Microsoft, Pfizer, PayPal, Facebook and Amazon all reporting. So I'll be interested to see how they report, but I do expect the trend to continue to the end of the year.
And those tech stocks, the so-called FANG stocks, they haven't underperformed the Dow, but the Dow's done at least as well as the FANG stocks this year. So there really has been a bit of a shift towards those cyclicals, financials type stocks. But I suppose whether that continues or not is very dependent on the pandemic.
Yeah, it's dependent on the pandemic for a number of reasons. And I think the main thing to look out for is certainly those inflation numbers, as I mentioned earlier. The reason being is interest rates obviously drives forward valuations. And hence the reason why you're seeing a bit of a turn around out of the tech stocks pre-pandemic into more your value stocks such as your financials.
Okay, so what about Europe? How is that performing? And I noted late last week, London certainly came off a bit, but the ECB came out and said it expected to keep interest rates lower for longer, and that helped the European bourses. How would you take a read on that? Because Europe traditionally has never kind of been favoured by investors, but it's kind of looking better now.
Yeah, and the reason for that, I think, is the success of the vaccine rollout across Europe and the UK. So the UK is sitting at around 60% and the rest of Europe around 50%. And so there is that expectation that the economic recovery will happen a lot sooner than, say, the rest of the world. The ECP is an interesting one. They recently raised its inflation goal to 2% earlier in the month. President Christine Lagarde hinted that a change to the bank's guidance, which is reflecting slightly higher tolerance for inflation, is the new strategy. So what does that mean? It means that the market has taken this as ECB is not likely to react to inflation on more than 2% by raising rates, and more stimulus for longer as the global economy recovers, helping support the market. So there's a lot of stimulus in the market. There's a lot of support there. So the way I take that is that even if interest rates do go above 2%, there is an appetite for it. Interest rates will not be going up anytime soon.
So I suppose the question for an investor, if you're sitting in Australia and I want to buy into overseas stocks, and you look at Wall Street versus European markets, and Wall Street has done better than Europe over the last decade or so. Is that still going to be the case, or do you think Europe's got a little bit of steam going there and so it may well outperform?
Yeah, from a CMC perspective, we certainly see most of our traders in the US market, and so there is a lot of interest there. That may be partly due to the rise of popularity in meme stocks such as GameStop and AMC, for example, or the fact that CMC's recently dropped its brokerage to zero for trading US stocks, and so a lot of the interest is based in the US.
But there must be opportunities then in Europe, I suppose is where I'm going.
Oh, yes, there certainly is. I mean, the European market at the moment is also similar to the US. It's also undergoing the reporting season. And again, the similar trend is that we're expecting earnings to outperform the market there. So more so recently in the reporting season, you've got Julius Baer, for example, which is a Zurich-based wealth manager, posted a rise of 23% net profit, or 606 million francs. So again, you can see that outperformance in market there. Novartis, which is a drug maker, beat expectations for the second quarter. So again, a lot of opportunities in Europe.
Okay. So what about Asian markets? Is there much interest in Asian markets at the moment? And I suppose the main ones are Hong Kong, Shanghai, Singapore, Japan.
Yeah, that's right. Asian markets tend to be lagging other major currencies, and this may partly be due to the slow rollout of the vaccine. The US, Europe and UK, as I mentioned, have over 50% of their population vaccinated versus Hong Kong and Japan sitting at around 20%. There's expectations that the economies in the US, Europe and UK will outperform that of Asia. Having said that, this will certainly turn around once we see those vaccination rates increase. At CMC Markets, the Hong Kong market is the most popular for our customers, with trading in Tencent, Alibaba and Xiaomi.
So what about trading in some of those Chinese companies at the moment? Has it come off a touch given some of the changes in policy from the Chinese government?
I think in the last few months we've seen that stabilise a lot more. If we're going back a year, yes, you certainly see a lot of volatility there, especially with the riots that's going on.
Stay with me, Cindy. We'll be back in a minute. My guest this morning is Cindy Leung from CMC Markets. Okay, so now I want you to give me a 101 now. So let's say I've got $10,000 and I want to invest it overseas. I don't want like the local market. So I'm going to go to Wall Street, or let's say London, or one of the European markets, or one of the Asian markets. I'm not asking you where I should go. That's okay. But what should I be thinking about? And I'm leading you down the path of exchange rates, what to look for in funds, that sort of thing. So as someone with $10,000 to invest overseas, what are the things I should be going through as an investor in my mind?
I think you should be going for big name brands that you're comfortable with. And yes, I do think, as I said earlier, I do think the market may be a little bit expensive at the moment. However, given the low interest rate environment and as the economies start to recover from the pandemic, my preference is still to be invested in the market. In my opinion, we should be buying the dips. And as you mentioned, when trading international shares, you've just got to factor in the currency movements. Again, what affects the currency movements is certainly interest rates as well. So keep an eye out for the inflation figures.
The theory being that if inflation comes through, interest rates will rise and markets could get hurt?
That's correct. Yes, that's right.
Okay. And then again, I've got my $10,000 and if I had money, I'd put it into the local share market. I suppose what are some of the benefits you get from overseas markets though?
Well, in the Australian market, we're really driven by two sectors, really. It's the mining and the banks. And so if we're looking at for a more of a diversified portfolio, you really need to look offshore, and especially on the value front and growth front as well. Leverages into technology, for example, with your best placed, companies like Facebook, Netflix, Alibaba, for example,
Yep.
are all based offshore. And so you just get a greater diversification, a well-rounded portfolio if you do look offshore.
Cindy, thanks for talking to Fear and Greed.
Thank you, Sean.
That was Cindy Leung, Senior Wholesale Relationship Manager at CMC Markets. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.